In this analysis, we have selected 3 high dividend stocks for you that could be interesting for 2025. And not only that, they also pay out high dividends of around 6 to 7%. That sounds great, of course. Nice to invest in high dividend stocks, 7% payout per year, substantial income, living off the interest, nice, doing nothing. Just be careful with high dividend stocks. I have been investing for more than 10 years now, and I am by appearance a growth investor. Sometimes I have shares in my portfolio with dividends, for example. I would never specifically focus on high dividends stocks. And actually, the reason for that is very simple. Companies that pay out a lot of dividends, they probably don't have better options than to reinvest their money. For example, in their business model, ideally, you want management to reinvest money into the business model for long-term growth, or maybe even buy back shares when they are undervalued. But my last preference would be to pay out a bit of dividend. But anyway, if you have a strategy based on dividends, for example, because you're a bit older or you want a bit more stability in the short term, then high dividend stocks can be a good choice. But be careful with that. Because stability is, if you ask me, a kind of false security with high dividend stocks. Yes, they pay out high dividends, but that's exactly what I see as a reason, a concern, often for the long-term growth. And the last thing you want in a special portfolio for example, your retirement savings, is that some of these stocks are dropping hard. So you shouldn't just look and get fixated on the dividend, but mainly look at the business. Does it also have long-term growth? Well, no one has a crystal ball, and we can't possibly link thousands of stocks all together and know from within. And we publish on this channel, Happy Investor, many stocks for readers as inspiration. So a solution that to be able to share valuable content, we use a number of tools. They also call that factor analysis in combination with some other tools, where we look at the potential for the next 6 months, even up to 3 years. And thinking a bit more about the short term is a bit easier than thinking long term, because no one really knows for sure what the long term winners are. So the strategy for these high dividend stocks is selected based on statistics, a bit of fundamental analysis, and very important for the next 6 to 12 months. So more short term, where you want to reevaluate every quarter what is still going in the right direction. And actually, you want to hold on for at least 12 months, but preferably, of course, even longer. However, if it is the case that you are buying these high dividend stocks for whatever reason, because you believe in it, and that's your own choice, then you definitely want to reevaluate every 12 months. Yes, is all of this still okay? Is it still a good dividend stock within my portfolio? Or should I maybe opt for a safer choice? And this is actually all about rebalancing your portfolio. Well, enough talk, and let's take a look at the 3 high dividend stocks of this edition. The first high dividend stock that could potentially outperform in the coming months is Enterprise Products Partners with the ticker EPD. Now, this company has an economic moat, according to Morningstar. Let's take a look at what analysts are saying. Well, 20 analysts in the field give a price target of about plus 10% or so. And it stands out that the latest target range isn't much lower. The Morningstar rating is 3 stars. And we indicate that this company has a strong competitive advantage, a moat with a fair value estimate. So an intrinsic value calculation of $32, while the current price is $33. New Enterprise Products is quite large in America and mainly builds infrastructure for midstream oil and gas. And the latest figures were from 2024, recently published. Well, to beat the market, you obviously need to have a bit of momentum on your side, because this is obviously not a great company when you talk about a great earning model. It's not an asset-light earning model, just to give an example. So there might need to be other factors to be able to outperform. And at this moment, the stock seems to be in a good position. And one of the reasons is, for example, because they are just making more and more profit. And the management also indicates in the latest quarterly figures that they see quite a few growth opportunities. We see these opportunities for the coming years. And of course, as well, for 2025, they have $6 billion in organic growth projects that will currently generate cash flow. And what we also have, of course, is President Trump. That is an advocate of oil and gas. So there are a number of, let's say, macroeconomic developments that could be interesting for this company. Of course, you also want to pay a fair valuation, a fair price. And according to Morningstar, it's around the fair value estimate. Well, if that's true, then you definitely want the company to start making a profit. Let's take a look at a few characteristics. If we look at the price adjusted with the operating earnings, the EPS, then we see on the long historical scale that the price has been running below the fair value line for a longer period. And the fair value is, in this case, price to earnings is equal to 510. Let's zoom in a bit more for a more current situation. And then we see that he is still, well, it's below that intrinsic value line where the price to earnings is equal to 15, but still a bit above the normal multiple. It's also good to know that if you want to invest in these kinds of companies for the long term, then you need to look at the business model. And I already said, this is not a great business model. It's also a capital intensive business model. That means they have to invest a lot in their equipment and facilities. They also require a lot of maintenance. So those depreciations are huge. So you end up with a lot of depreciation. Then you need a lot of cash to do that, to replace that. I invest as a growth investor, mainly in companies with an asset-light business model. Basically, you can achieve revenue and profit growth with minimal investments. You often see that in software, but also in other types of companies. What is also the case with EPD and with many companies is that it's not a great company for the long term. So keep that in mind in your decision making. And you can see that, for example, just by looking at the performance compared to the S&P 500, the compound growth isn't too bad, you see, but is 8%, while the S&P 500 is 9%. And of course, you want to select companies that can beat the S&P 500 for the highest possible return. Indeed, this company pays out a lot of dividends. So we've already talked about that. Companies pay out a lot of dividends that they don't invest in their own business model for future growth. But that money does go to the shareholders. So those are important considerations to keep in mind, no matter what type of investor you are. Let's take a look at the forecasting. Of course, it's interesting to know that now the current price to earnings ratio has indeed increased from 10 to about 12-16, which is the normal multiple. Over the past 5 years, the prices have actually been willing to pay about half of the stock profit ratio. And let's say that this is in relation to the EPS estimates that we see below. That means an average annual return of 8.5%. This includes dividends, and the dividend is relatively high. So that actually means that the price will just move horizontally for the next 2 to 3 years. A small plus, and of course, you receive a high dividend, 6%. This multiple might actually be low. And that's because of, for example, the momentum. And for example, if Trump pushes through all sorts of plans for oil and gas, more capital investments are needed, then the company will, of course, try. And then the story actually changes. And the valuation might become more attractive for Mr. Market. For mind you, Mr. Market thinks short term. If you don't know what Mr. Market is, then read the book, The Intelligent Investor. Well, it could be that maybe that multiple will be a bit higher. For example, 13.6 as an example. And if we stick with 13.6, then we see an average return of about 16% per year. So you can obviously use all sorts of different multiples in your analysis. Let's say the price to earnings ratio is 15 in 3 years, with the corresponding EPS growth of 6, 7, and 4%. Yes, then you have an average return of 19% per year. It may be that this company or the share must, I'm saying it might surprise us. But yeah, this is all theoretical, of course. Scenarios. So you need to come up with your own scenarios. Best case, but also especially worst case, and see, yeah, listen, nice and all this potential return, but what is the risk? Is my money at stake? And that mainly has to do with your time horizon. Because if you only want to invest for 3 or 5 years, for example, because you're retiring, I'm just saying, right, then you need to make sure that you're not taking on too much risk. Well, also speaking of risk, here we see the valuation of this stock. And we can see here, for example, that the market cap is 70 billion. Okay, that doesn't say much, but that total debt is quite significant. So they have about 30 billion in debt, long-term debts, partly short-term debts, but they also don't have much in cash positions. So, yeah, the higher a company's debts, always the more risk there is, because something can just happen. I'm just saying something like sex, a kind of innovation, breakthrough in sustainable energy, which makes oil and gas suddenly unnecessary. I can hardly imagine it, but that's often the case. People can't imagine it. No one takes that into account. And then a black swan and an unforeseen event occurs, and some companies, they get partly swallowed up by a disruptive innovation. That's just one example. I'm not saying it's going to happen. The chance is small, but the chance exists. So keep that in mind when you're talking about risk management. All right, so the valuation right now is around 11.5. Quasi earnings for next year. The metrics don't look that great. Quasi earnings are also a bit on the high side compared to the sector median, and also a bit higher compared to the 5-year average. And the dividend is 6% per year. When it comes to dividends, they're doing really well, I must say. The dividend looks pretty good, and the growth looks quite decent as well. And what you obviously want to know is the long-term EPS growth. In this model, it's estimated at 4.7%. Earlier at Fixed Kreftag, estimates of around 6-7%, and then 4%. So it could be true that for the next 5 years, the KEGA EPS growth could be 4.7%. The higher, the better, of course. The profitability isn't great. Nevertheless, they do have an economic moat, but the profitability isn't really superior. Compared to the sector median, 10%, the return on equity is really high. That's definitely a positive sign. On the return on capital, yeah, 6% or 7% isn't great. But, okay. When you talk about dividends for next year, the dividend payout is estimated 6.5%. The payout ratio is about 77%, pretty high. And you see dividend growth for 26 years in a row. Dividend growth achieved. That's really good, of course. So 26 years in a row, dividend paid out. And let the dividend grow again. It's a high dividend share. Let's take a look at the dividend growth. From the past period, that's around 3.5%. It's not a lot, but hey, they do pay out high. Dividend out. So it could very well be a really interesting dividend stock. But in the short term, you also need to know what the volatility is like. And of course, there are also risks. Can such a company also be closed permanently or completely? Go partially bust? That's of course also a question in the very short term. Zexgenk indicates a buy signal. So Zexgenk also expects that the company, where EPS is expected to outperform earlier than anticipated, that's a positive signal. The price target has been set by them at $35, a bit in line with what we saw earlier. Analysts are saying $36. And keep in mind that the EGOT EPS score chart, it's running above the EPS line. So Goose is running above the EPS line. Most of the time, you'd actually prefer to buy when it's below that. But yeah, you can't have it all in the world. They give a number of reasons to buy, and especially a number of reasons to sell. And then the part about debt is also emphasized. There are a few other things that are quite important. You can pause the screen if you want. If you want to read this, do that especially. Then we have a very small piece in the short term. Well, recently it had already dropped by about 10%. Speaking of volatility, imagine you're investing in retirement with full confidence and you buy the stock only to find yourself down 10% the next day. Well, that doesn't make you happy. So yeah, but that's the short term. You're going to see this stock more often. It's dropping here by 18% in a relatively short time. Of course, it has dropped a lot here. The Corona crisis dropped by 50%. But okay, that's the Corona crisis. Exception, minus 15%. And you often see that probably around earnings, it drops by about 15% each time. It could also be a buy the dip opportunity. If you really believe in the company for the long term, it could be a buy the dip opportunity. If you believe in a bit of technical analysis, with potential support and resistance levels, then we first have a peak here of 30. So if this peak doesn't break through upwards, then it could be that the price starts to drop afterwards. In the short term, maybe down to a level of, for example, 28. That could actually be a really nice entry point, by the way. But thinking the other way, if it does break through, yes, the all-time high was in 2014 at 41. If you believe in this, technical analysis suggests there's about a 30% upside potential. I would always look at the fundamental developments. I have to say, it looks good in terms of momentum, in terms of numbers, also what they indicate. Definitely read everything from investor relations. You need to invest at least, let me say, there is no fixed rule, but you need to invest a lot of hours in a company to learn, understand. This is just a quick analysis of a company, so this is never enough to make good investment decisions. But at first glance, it looks positive regarding developments. And also macroeconomically, for example, Trump boosting oil and gas. Boost. It could all turn out well for this company. High dividend, 6% per year, possibly with some price potential. Yes, that's it about EPD. Now let's take a look at the other two high dividend stocks. HSBC is a very interesting high dividend stock. The dividend is around 5.5 to 6%. But actually, that's the least interesting thing about the stock, because it has a very interesting setup to potentially achieve high returns and to outperform many index funds for at least this year, 2025. HSBC. Let's take a look at what this company does and what the characteristics of the stock are. First of all, it's a bank, a very large bank in the United Kingdom. And are we looking at the analysts' ratings? They indicate that it's a buy. By the way, there are only 3, but they give a price target of around 58. That indicates a potential price, an increase of 7%. And that's quite attractive if you're also receiving a high dividend. Morningstar indicates that their intrinsic valuation is $57 per share. And the current price is $54. They receive a 4-star rating. A number of interesting things we see with this stock, which makes it stand out. And that it's interesting to mention, if we look at the overall price development in the long term in relation to the valuation, so it seems that the stock is still undervalued, despite a significant price increase in the short term. And a somewhat similar setup we actually see in 2 cases. Once, again, after significant declines, whereby afterwards the profit has risen significantly. And then you also see that the price is rising quickly because of that. So basically, it's actually more of a value stock, a value stock rather than a dividend stock. But anyway, putting the terminology aside, the current price of earnings is increased, but was very low and has now risen to about 8.3. Looking at the forecasting, what could that mean? Well, the normal valuation for the HSBC stock is a price of earnings of 10. That's on the lower side. In the past, it was also a bit higher, and the bank, let's just assume 10 for safety. The price earnings have risen significantly due to the price increase, but it's still only 8.9. It's not super low, but it's also not high. And if we look at the EPS estimates from analysts, they're not groundbreaking. But there is profit growth. And yes, if the price is low and you have low profit growth, that's still interesting. Even though it's a high dividend stock, so the upside potential could very well be there, about 16% per year. And that will never go in a straight line for the coming years. It will go with ups and downs, but in potential, it could achieve that. And even with a higher multiple, for example, 12, it could achieve even more return, namely about 23% on average per year. Note that this is including dividends. The characteristics are indeed interesting. We also see that reflected in the factor analysis, which gives a strong buy because the valuation is relatively low. The growth isn't great, but at least there is profit growth. He provides strong profits, but also momentum and revisions. In other words, analysts expect that the stock will make more profit in the coming period. That's often related to strong momentum. And the price earnings for next year is estimated at around 7.7. The price to book ratio looks okay, but hey, pay attention. This is a bank. I don't invest in banks myself. I don't have expertise in that. So I think it's good to know what you're doing. And also note that banks can always, pull off some strange tricks with price to sales. Well, price to cash flow is 5.2, so it's actually not very high, and the new venture is 5.7%. They obviously have huge debt loads, but also a lot of cash reserves. So yes, Hedges BC can benefit from relatively high interest rates, and that doesn't seem to be done yet. Let's look at the growth. Well, that's not super high. At least that's what you would think. The revenue growth for next year is estimated at around 8%. And here we do see different estimates, 22% EPS growth, while at Fastcraft we saw from safety analysts that it's actually quite a bit lower. So one of the two is not correct. And then the question is, of course, who is right? So it's important to really know the company well and take a look. What are the good opportunities? What stands out is the high profit margin at the moment, 40% profit margin. So in some areas, they're doing it small and very, very well. But this is also a risk. You can see that the profit margin of 40% is significantly higher than the 5-year average. There are definitely a few bad years in there, also because of the coronavirus crisis. But that 40%, how does that align with the long-term history of the company? And that 40%, that's the crucial question. Is that sustainable, yes or no? If that drops, then the PE ratio will quickly rise. In other words, the price earnings ratio, the return on common equity is relatively okay at 12%. It is also above the 5-year average. So it is clear to see that the momentum of this company is justified, also based on higher profit growth. Finally, a piece of dividend. The dividend for next year is set at 5.7%. And if we look at the history, yeah, then it's not really a super stable and reliable dividend. The share has proven itself, but still, they have paid out dividends for many years in a row. Only interrupted, of course, during the coronavirus crisis, which makes it seem like they haven't paid out a lot of dividends consistently, but that's purely due to interruptions from the recent period. Zexshenk indicates a hold rating based on EPS, earnings per share, and their price target is in line with Morningstar's fair valuation, which is $57. The current price is slightly lower. They provide a number of reasons to buy, reasons to sell, and of course, risks. It's a bank. Looking at the very short term, it's quite an interesting setup. The momentum is really very strong, recorded. And then you might think, yeah, isn't it too late? Isn't it too late now? Compared to 2024, for example, increased by 36%. So we have a high dividend share with a price, an explosion of 36% in a year. Come join us. Well, you often see that the momentum keeps going because the momentum is, of course, based on something, based on the development. And that's very interesting to develop, to investigate what that means. Well, a few things. First of all, you want to invest when prices are low. And for example, after the corona crisis, the bank was slightly adjusted. But then in 2022, the momentum on the price was still very low. And you can even see that level 100% return. So when do you want to invest? When a company is undervalued. And I don't think HSBC is really strongly undervalued at the moment. So you mainly want to follow companies in a certain sector for a long time and then wait until they are really clearly undervalued with a margin of safety. Well, yes, I think that's a solid basis for HPC. Only the momentum can really keep going. Again, I'm not a banking expert, so pay close attention to what's happening in the banking world. But yeah, you don't need to be an expert to understand what's going on right now. Well, if you believe in technical analysis, then it could be that there is a resistance level around this price level here of 55. So he's almost there. It's really interesting to see what happens if he jumps past that 55, or if he then breaks through to that 62, or maybe even above that to the 100. But anyway, that's purely based on technical analysis. We see, and I think this is the most important thing, that based on factor analysis, the stock scores strongly. It still has relatively, namely, interesting relative valuation. We see that the momentum is very strong, the profitability at this moment is very high, and we see that there is potential for upward movement. So yeah, those are much more important matters than, of course, the technical analysis. But if it's all and it can actually be very interesting. So I'm very curious. I'm not going to invest in the stock myself, but I'm curious to see what happens. If it approaches that 55 and maybe even breaks through to that 62, exciting, fun. Now let's take a look at the third high yield stock. Omega Healthcare is a real estate fund with a relatively high dividend. And when you talk about the long term, they invest in elderly care. So in the long term, I think it's quite relevant. They have investments in the UK and especially in the US. Take a look at the website. There's a lot of information on there. The total real estate investment is about 11 billion. One thing that also stood out to me is that the director, the CEO, has been active since 2002. Doesn't have to say everything, but often it's a good sign that the CEO has been in place for a longer time. By the way, the company has also been paying a dividend for 20 years in a row, so it's good to know what really matters as a dividend investor. The ticker is OHI, Omega Healthcare. Well, they are, of course, active in healthcare. And we're going to look at a few characteristics of why this could be a top dividend stock with also a high dividend. First of all, the analysts' ratings. The current price is around 37. They indicate that there could be a 30% upside potential. And Morningstar. It gives a 4-star rating with a fair value estimate of $41. And Morningstar, of course, looks at the intrinsic value, what is for the long term. But before you start cheering, Morningstar, regularly adjust the intrinsic value. So yeah, what do you really gain if the price drops? Then they often lower the intrinsic value. So yeah, you don't really gain much from that, you could say. So it's better to do your own research and determine how much the fund is actually worth. Well, in this video, we're going to look at a few characteristics. What we see in the historical valuation is that the price is finally a bit below the fair value. Line is set, that's the orange line. But you can see in the past that this has happened more often, that it often even lies below this blue line, which is the normal multiple. And the normal multiple is actually significantly lower than the fair value line of price to disposal is 15. We're looking at price to disposal. Adjusted funds from operations, well, because it's about a real estate fund. Let's look at potential returns. What could it be? Well, if you stick to the normal multiple, that's a price to disposal of around 11. That's definitely on the lower side, especially compared to other types of real estate funds. But okay, there is no reason to assume that it could be higher. Now, the current price to disposal has risen to 13.8. We see here the earnings estimates from analysts. And if we stick to the normal multiple, it means an average annual return of about 3.7% for the coming years. That's not really super interesting. So when does it become more interesting? If that price to disposal stays the same at 13, then it starts from 9%. And then it definitely becomes a bit more interesting. But yeah, there's always the question of how much return can it actually achieve? So you might want to calculate a bit more cautiously and with less, enough taken if you want to invest in this. Still, the stock can surprise us. It currently scores a strong buy based on factor analysis. That's actually due to the combination of attractive valuation, higher profitability, momentum, and revisions. In other words, analysts expect it to make more profit and now expect. And we can also see that reflected in these analyst ratings. And we might see in the short term that there could still be some profit to be made. If you want to invest a bit more actively and also have some patience, that valuation is maybe a bit more attractive, but not super attractive. If we look at the prices for next year, it's around 13. And yes, that's a bit lower than the sector median, but not much lower than the sector median. And don't forget that there are also other great real estate funds. So we regularly do analyses on real estate funds that might be interesting. And there are definitely a few top picks for the long term. The growth isn't really that interesting to mention, besides the fact that people expect the EPS growth to be quite attractive, with about 3 to 4%. Well, that's always more than 0%. Let's look at the profitability at this moment. Then we see as we scroll down a bit, that the return on total assets is indeed a bit higher than the sector median. Also, the return on capital is higher than the sector median. Within my app, 4% isn't extremely high. And what's interesting is that the mutual equity is 10%, and that is indeed significantly higher than the sector median. And the mutual equity is, of course, important for a real estate fund. So that might be interesting. Let's look at the dividend. Well, they pay out a high dividend. For next year, it's estimated to be around 7%. They pay out a lot, of course. The payout ratio is 90%, but that's, of course, what real estate funds have to do. They have to pay out a lot. And we see that for 20 years in a row, they have been paying out dividends. This has been interrupted for a while, but they have been paying out dividends for 20 years. The dividend growth is just not remarkable. In the very short term, recently we see a price drop of about 10%. Of course, if you keep adding each time at minus 10%, that can work attractively, provided it's a real estate fund. In the long term, it grows. The same goes for every company, of course. Also take into account opportunity costs. But what we see is that the fund has been moving fairly horizontally over the years. Only because of the coronavirus crisis, it had dropped significantly. Before the coronavirus crisis, it was about 15% higher. And what you see are actually some regular drops here of about minus 30%. That has happened about 1, 2, maybe 3 times. Let's set the coronavirus crisis aside for a moment. It could very well drop back to, for example, minus 15%. And there it finds a new support level. But if you believe in technical analysis, I'm not saying it's wise, but if you believe in it, and there is certainly some truth to it because there are several players who do the same, so you can see that there might be a support level here. While the valuation isn't extremely high, the factor analysis is positive. There is momentum, and it's quite strong, so there might be a reason to assume that it will continue to rise. The question is also why Analysts also expect that the Omega Healthcare will make more profit than it does now. Maybe that's what's expected. So it could be that there's upside potential, and it's very interesting to see what happens. If he ever reaches that price level of 45, that's an upside potential of about 15%. Why Omega Healthcare is interesting as a dividend stock for this year. I personally wouldn't invest in it, but that's up to me. Maybe you see the potential in it, and keep that in mind. You have volatility with real estate funds. There is also the influence of interest rates, of course. And actually, it is the same if you invest in a real estate fund with a good long-term strategy, then you actually always want to buy more whenever it drops by 20 or 30%. Those are the nice moments to buy more. And then you have the interim high dividend, which allows you to just wait patiently and collect dividends.